Hello everyone, hope you're doing all right. So, welcome back to the second execution review. Now, today we are going to talk about a few things. First, the 3 trades that I took. Second of all, risk management and how to mitigate drawdown, etc. So that's quite interesting. Now, as you may have saw, Australian dollar has been exploding up currently. Let me just give you a quick outlook. Australian dollar CHF had my interest. There was actually a trade, but I wasn't trading New York. There was a SIBI, BISI right here, SIBI right here. Perfect trade, would have been an execution. Another SIBI right here. This is a clean entry on Australian dollar CHF. It is what it is. Then on Australian dollar USD, I'm currently still expecting a little bit lower prices because I don't think my bias on Australian dollar in itself hasn't really changed that much currently. Yes, we had a huge spike up, but order flow isn't established bullish currently. So there's still bearish order flow in play. So I'm a little bit waiting on what price does right here. And maybe that will present some nice trades on Thursday. Tomorrow, so tomorrow is Wednesday, today is Tuesday. Tomorrow I'm not trading. Why not? Well, there's that pre-NFP announcement and there's FOMC in the evening. I'm just staying out. I would advise you to do the same as well, or drop your risk and trade demo and see how it ends up. But don't trade the news events in itself. Just don't. All right. So as you can see, I took a loss right here. This was a loss. Then Australian dollar USD was 80% partial right here. And this was full take profit hit. Now, the thing is, I showed you 3 different risk management approaches here. And that's quite interesting because then you can choose, or you can take inspiration from it and you can apply your own thing that you want to do. Now, one of them was partial, one of them was full take profit, one of them was holding over Monday and having a very big target essentially. Mondays are generally not known as trending days. Mondays are generally false days, as I like to call them. And false days are Monday and Friday. They tend to do the opposite of the trend. So for example, Tuesday, Wednesday, Thursday are trending days. They are known as trending days. This doesn't mean that Monday can't set the high or low of the week. That can happen. That's not really relevant in this case. But just know Mondays tend to be, or can be, a consolidation as well. They are a bit more tricky. The probabilities are not necessarily always in your favor on a Monday and Friday. So by knowing this and by gathering data, because that's what I did, I know this. So that's exactly why I aim for the low-hanging fruit on Monday and the easiest target. And this is exactly what I said yesterday, what I would want to avoid on a Monday. Imagine if price is all the way here and it hits your stop loss at the beginning of the week. And now your emotions is all acting up, etc. And the rest of the week is basically a mess. And that's what can happen. You could start revenge trading, over trading, etc., etc. So that's why I tell people, easy target on Monday, have that low hanging fruit on Monday, gain that confidence, etc. Now, as well as some people might think I'm risking 1% on each of these trades. That's not true. Well, first off, it's Monday, so my probabilities are not in my favor. So Mondays always a reduced risk for me. Second of all, I'm taking 3 trades yesterday. And they all involved Australian dollar. I was basically saying Australian dollar is going down. So keep in mind, I'm basically trading one currency at that moment. If I were to risk 1% on every trade that I took, I would have risked 3%. If every single one of them was to lose, I would have lost 3% on basically one setup. Why is it one setup? You're basically going all in that Australian dollar is going down. So you're basically risking everything on one asset, on one market, on one pair. So the thing I like to do, and the thing I would recommend you doing as well, you only, if you are, and I always preach this, execute on one pair. Execute on one pair only. You can analyze multiple pairs, but execute on one pair. Find the relative strength leader through the filtering process, which one is going higher easily, which one is going lower more easily, and execute on that pair. The next thing, if you are going to execute on multiple pairs, you're not risking the full amount on every single trade. I risked 0.3, 0.3, 0.3, for example. Now, you're not going to risk 1, 1, 1. The total amount of those 3 trades should add up to 1%, should add up to your normal risk parameter. So if you were to risk 2% normally, then these 3 trades should max. So the maximum amount that you should risk in total of these 3 trades combined should be maximum 2%. If your normal risk amount is 2%, if your normal risk amount is 1%, then drop it, and the total combined value of these trades, of these 3 trades, should add up to 1% maximum. So the next thing is, if we took losses on all 3, if you risked 3% on one trade, basically, you would have, with a 10K account, you would have been in 3% drawdown after 1 day on a Monday. Now, if you were to apply the thing I did, you would have been in 1% drawdown if you took all 3 losses. Now, here, a major difference. This is a major difference because those 2%, it already seems like a lot, right? If you just look at the numbers here, it seems like 3% drawdown and 1% drawdown. That's, for your emotions, is a major difference, especially on a funded account as well. It's a major difference. And of course, 3% drawdown is not that bad, but if you had profits in clean months, and right now you are risking 3% in 1 day, that's completely messed up, because if you lose that 3%, you're basically blowing all your profits within 1 day, within one setup even, because we were anticipating Australian dollar to go down. So this was all based off of one thing, which was the Australian dollar. Australian dollar had all the power, let's put it that way. So you're basically risking 3% all your profits on one setup. And that's not a thing you want to do, because then that's where a lot of people go wrong as well. They have profits, they can make profit, and then when a drawdown period comes, they lose all the profits and even more, and might even blow the account. Everyone can make profits, and don't worry, making profits is not that hard. Of course, in weeks like this, months like this, where price action is not that clean, it's a bit harder. And you don't actually have to make profits. This might be a drawdown week for you, or last week might have also been a drawdown week for you. That's perfectly fine. And you can know this by looking at the low probability conditions, etc. So by having these things, and by not blowing your account after one low probability week, that's a major difference. That's when you actually become a professional. Everyone knows how to take profits. Everyone can make profit in this game. The thing that separates a lot of people from the amateurs is knowing how to keep those profits. That's the major difference. So risk management should always be a major role in your trading. Risk management is so key. So there's a few things I like to go over for determining my risk management. Now, the first one I'm writing down right here is high probability conditions and low probability conditions. I like to look at the probabilities and are they in my favor, etc. Currently, and the past week. So this week and last week, the probabilities haven't been in my favor, and I've been more wrong than I've been right on the higher time frame analysis. So then I drop my risk accordingly. I notice the low probability conditions and I drop my risk. Now, for you to increase and drop your risk, etc., of course, it takes a little bit of experience. So I have two different methods as well that I also like to apply. Let's not call it that. Let's call it starting balance. And then the third one is risk parameters. Let's call that. Now, for the second one, starting balance, I like to take my starting balance. For example, if I'm trading a 10K account, 10K, then the starting balance is 10K, obviously. Everything below 10K, I'm risking 0.5%. Everything above 10K, I'm risking 1%. So if I were to go into drawdown below 10K, I would drop my risk to 0.5%. If I were to drop below 9,500, so I would have already lost 10 trades in a row with 0.5% risk. Then from there on, I would risk 0.25. Now, this allows you, and let's say we have a 10% maximum loss on a funded account or anything. This allows you to lose 30 trades in a row. Of course, if the account is live, if you have a time limit, etc., it's a different story. If you have a live account, this allows you to take 30 losses in a row before you blow the account. 30 losses in a row. Now, a lot of people will not reach those 30 losses in a row. Especially not us, because we have a certain plan, etc. We are not losing 30 trades in a row. We simply aren't. The only way we can lose 30 trades in a row, if we don't stick to the plan, if we are not disciplined, if we are, if we aren't even getting to the 30 trades, so we are risking way too much to get out of the drawdown, because a lot of people think when you get into drawdown, or risk more to make everything back as quick as possible. No, embrace the drawdown. It's uncomfortable being in drawdown, eh? It's uncomfortable as fuck being in drawdown. It is. It's just not nice. It's not a nice feeling, but it is what it is. And we can't do anything about it. We have to accept it and we have to move on. And being in that, get comfortable in that uncomfortable situation. Now, a lot of people will over leverage. So they will risk maybe even 5% on one trade and they will blow everything. So it didn't take them 30 trades to get to 9K. No, it took them maybe 2 trades. And that's where a lot of people go wrong. So then if we just stick to these risk parameters, we can't fail. We could flip a coin and still make money. Why? Because our risk management is absolutely on point. So then it comes down to you. The only thing that can fuck up is you. Your emotions, your psychology, etc. If you stick to the risk parameters, you can't fail. It's as simple as that. And that's why trading is psychology. It's not necessarily about the technicals. It's psychology. It's the mental game. It's not really about technicals. It's all inside your head. It's all inside your mind. So that's what I like to do now as well. Of course, let's not only focus on drawdown. If I were to trade up to 11K, let's say 11K, and we made 10% profit, then if I have a live account, I like to use 10 or not 10%, 2% risk. So a 10% profit in total, 2%. I can maybe compound those profits a little bit. But again, if I'm dropping below 11K, I go back to 1% to mitigate that drawdown until I'm back at 11K, and then I go back to 2%, etc., etc., etc. So that's another way of doing it, and that's also what I apply. Now, the next thing is also a great option. Let's put this here. Let's say we are at 10K. We win the next trade, and we only take 1% profit. We win the second trade as well. Perfect. Now, the next thing we could do is, if we lose, we don't drop our risk immediately, but we could. You could drop your risk immediately, so that's a choice. Now, I like to take 2 losses. When I take 2 losses, so I take a loss here, take another loss here, drop the risk. Why? Well, if you don't have the experience yet to maybe identify those low probability conditions, you might be in low probability conditions right now. Not only in your technical, but also in your emotions. It's low probability for you to trade currently. So dropping risk to 0.5% after 2 losses. After another loss, so then you drop your risk to 0.25%. And you stay there. Stay there, stay risking 0.25%. And then we start winning again. After a win, we increase our risk again. Ooh, now the math gets difficult. And then see, it took 3 trades for us. 3, what is it? 1, 2, yeah, 3 trades, right? 3 trades to get back into a break even. It took us 1, 2, 3, 4, 5, 6. It took us double the amount to get into that drawdown spot. So only half of that, half of the trade. It took us 6 trades to get into 9850. It took us half of those trades to get back into profit. This is how you mitigate drawdown. Now, if you compare this with your static risk, where you always risk the same amount, you will see your drawdown periods, when you apply these risk parameters and these risk management approach, your drawdown will be significantly less than someone that risks the same amount constantly. So after a loss, after 2 losses, you drop your risk, you halve your risk. After a win, you double your risk. And you can apply the same thing you can combine it with your starting balance, etc. You can do what you think is best for you and what you like the most. Now, I like to use the starting balance method personally, but as well, I keep in mind this as well, the risk parameters and dropping risk and increasing risk when and where. So those are a few risk management techniques, and they are very important because drawdown periods will come to haunt you eventually, and they will happen. They will 100% happen. Now, the thing that separates us from amateurs is, in those drawdown periods, we don't actually experience a lot of drawdown. We experience drawdown, but it doesn't blow our account. We don't lose a funded account over a period of drawdown. And that's very important. A lot of people, when they go through drawdown, after a first week of drawdown, they will blow account. Now, keep in mind, drawdown periods are not 1 day. Drawdown periods can last up to a month, even 2 months. If price action is not favorable, drawdown periods will take you out. Absolutely, if you don't apply the right risk management approach. So keep in mind, a drawdown period of 2 months or 1 month is not that unrealistic. And you might experience it. And then having the right risk management approach is very key. So, all right, now the same thing, let me put it back as well. The same thing you could do is after the first loss, you could already drop your risk. So for example, right here, you could already drop your risk to 0.5% and then increase it after a win. Now the same thing applies. You could also increase your risk after 2 wins. So we win the first one, we win the second one, and then we increase our risk, sorry, to 1% again. This is also dependent on your data, so your win rate, etc. If you have a very low win rate, then this approach might not be for you. Why not? If your win rate is very low, so I'm talking about 30%, then you will basically constantly be at break even because you're constantly losing, and the only thing you are doing is mitigating the drawdown constantly without really taking profit. So you're a break-even trader essentially. If your win rate is on the higher side, so I'm talking about 60% minimum, 50%, 50, 60% minimum, then this approach is very well. Now, for if your win rate is on the lower side, your starting balance might be a better option. Of course, doesn't have to be a high win rate. You can also use the starting balance option, but just know the risk parameter thing that we talked about here. Low win rate is not ideal for this situation. All right, so that's risk management. And you can see that affects a lot of traders, and a lot of traders don't apply great risk management. And the thing is that I wanted to talk about real quick, because tomorrow we're not going to talk about trading. We're going to talk about a few conditions, low probability and high probability conditions, but we are not going to talk about trading. So I'm not trying to give you that expectation of there's a trade every day, because there isn't. And well, there might be a trade every day, but not a great trade every day. And having that expectation and me constantly, even on a day where FOMC, etc. is happening, that's not the thing I want to teach people. I'm not here to teach you how to trade on an NFP day, on an FOMC day. That's not how, in my opinion, that's not how professionals handle it. Now, the next thing I wanted to talk about, a lot of people, let's put it this way, a lot of people don't even apply risk management. A lot of people, if you have heard my fun at FX, I think, talk about it, a lot of people don't even use a stop loss. A lot of people, they get into trading, they buy a challenge, they don't use a stop loss. A lot of people don't bother watching ICT. A lot of people, first off, don't bother watching, buying my mentorship. That's perfectly fine. Second off, a lot of people buy my mentorship, don't bother watching all the videos. Don't bother watching the videos in the right order. Don't bother listening to me. Don't bother taking my advice. Don't bother taking the opportunity to learn. Don't, the list goes on and on and on. If you are just following the steps, etc., you're applying risk management, you're doing this, you're being patient, your emotions are in check, etc., you are already in the top 1%. It will surprise you how many people don't do the small, little, simple things. I was trying to teach friends how to trade as well, and they asked me, can you help us out? And I was like, of course, I can help you out. And we basically scheduled appointments for Monday and Friday in the morning, and then I would help them, etc. Now, we did that for 1 or 2 days, so the first week, and after that, they didn't show up anymore. And that's exactly what I'm trying to aim at here. A lot of people cannot even stay consistent for 1 week. A lot of people will try trading for 1 month and will quit. And that's simply why a lot of people won't make it. A simple set. A lot of people won't do the basic things. Applying risk management, keeping your emotion in check, etc. And then they are failing, and then they are surprised why it doesn't work. So again, you are probably already in the top 1%. I can guarantee you that, if you're just applying and doing the basic stuff. All right. Thank you, everyone. And tomorrow I'll see everyone again. And as well, tomorrow is a great day to practice your higher time frame analysis, because price will likely move fast, at least hopefully, or it will do it on NFP. And on NFP, on Friday, we get a new chance to apply the exercise as well. So if you remember the exercise, doing your higher time frame analysis on NFP and FOMC, so big news events, and then we can see and basically practice our higher time frame analysis on those days. So let me just end it with this. I was still looking at Australian dollar again. I do still think, if I look at this, that it might want to continue down just right here, because I'm not convinced just after a big spike. And that's what I talk a lot about in higher time frame analyst topic as well. Just one big spike doesn't convince me of bullish order flow. If this was to hold right here, this order block, then it's a different scenario. But just one big spike up isn't convincing me that order flow is bullish, and that's where a lot of people get tricked as well. All right, so I'll talk to you tomorrow. All right, thank you.